Let me now come to the next phase, which I wanted to discuss. It's about financial considerations. Now, financial consideration, we've been speaking in the past in the newsletter about operational readiness. We've been speaking about financial readiness. But obviously, nothing beats the experience of someone who's done it so many times, like Marguerite. So the question I wanted to ask you is, what financial metrics are the ones that we should look more into the details? We should really they matter the most when evaluating an Asian M&A target.
I think you should look at your target as a whole. So you will look at the financials, obviously. You will look at the profitability, the earnings. I would pay a strong eye at the quality of earnings. And by quality of earnings, I mean, is that sustainable? Is that reliable? Um, Obviously, you would look at the working capital and you will look at DSO. I would look at contracts. The commercial due diligence is key, really, really key. You want to know if what you're buying and whether it is substantiated. Um, and obviously the valuation metrics, so discounted cash flow, enterprise value to EBITDA, debt to equity. So those would be the what you want to understand is how solid is the business that you're buying.
Could we say that every dollar of EBITDA in Western markets is needs to be compared with another dollar of EBITDA, let's say an Asian economy with different ties, or can we say that a dollar of EBITDA in a sort of in a particular economy, can be analyzed in the same way as in Asia. In other words, how should we approach due diligence, when we look at the numbers? Is there something special that we need to pay attention to? Is there anything that the Western acquirers usually get wrong? Yeah.
Looking at the nature of the transactions within the P&L.
Mm-hmm.
I
So the
think
nature
that's
of the transaction, yeah.
yeah, I would look at basically all the individual transactions. I would look at invoicing. Um, I would look at contracts. Um, those are elements that allow you to really understand what is it that you're buying.
Okay.
Assets. I will look at the assets. A lot of the things that need to be looked on is sometimes the assets that are being used by the companies need to be replaced and are fully depreciated. So you need to make sure that you build that into your business model so that you're able to operate.
Yeah, this is something that we see a lot in so many activities. We tend to see that the book value doesn't tell the whole story, because personally I've been working on an Indian acquisition in the last few weeks, so I can tell you also about my experience. So we tend to see that the market value is so far away from the book value that we need to do so much more work on this. And I suppose that's also your experience, Marguerite, yeah?
Yeah, so it's looking at inventory. Is all my inventory expired? Um, I'm not saying this as a joke. Don't get me wrong, and it might not be the case, but these are elements that maybe in a Western world we need to be less cautious about. While in Asia, it's important to have a look because you may have interesting surprises down the line, and more importantly, don't underestimate the integration costs. What is the investment to bring those two companies together? And too little might end up having consequences and a lot of disruptions.
This is very, very useful to to have as a warning, as I said. So it's really really important that um, yeah, we gain the right knowledge, the right experience, and we're also meticulous with the due diligence. Yeah, you can never spend insufficient time on due diligence, so we say. So it's important. So the legal, the technical, the financial due diligence, the operational readiness of the business, as well as the financial readiness. Yeah. So operational readiness is where we can see how the business is going to potentially operate after the acquisition. Because let's not forget, when we invest $1 in an acquisition, we want to see more than $1 after a while, because that's what we do. We want to grow capital, of course. Yeah.
What
Um,
tends to happen, I suppose, is also if your due diligence is too light, then your integration plan will not mitigate all the risks,
mhm.
and that would end up with problems down the line. I'm not saying it cannot be addressed. I'm just saying it might take longer, or it would require additional investment that was not initially planned in your business case. So my advice here would be really to take the time to go through your due diligence, to understand the risks, to understand the gains as well, so that your integration plan is as close as possible to reality.
Yeah. No, thank you for this. This is such an important point you're making here. It's about really so many unknowns. I mean, when you start an acquisition process, you have to effectively, yeah, I mean, personally, as a CFO, sometimes I see myself as if I'm working for two companies, not for one company anymore, because you have to spend time on not just on your company, but on the company you're acquiring. It's as if you're watching every day what's going on in the company you're acquiring. So you cannot take your eyes off. You just cannot take your eyes off. You have to really uh you have to really get the right due diligence and assume that you're already managing that business. Um,
Exactly.
in terms of deal structure, I wanted to ask you this question. Are there do you see, obviously, in your experience, creative deal structures, like, for example, the earnouts, the vendor financing, anything that you see? Tell us all about it in Asian markets.
Absolutely. Most of the transactions I worked on have earnouts. Um, some even have an earnout over 2 years. On occasion, I've seen sellers joining our business for the period or duration of the earnout, because it gives them hands-on, ensuring they get that earnout. Obviously, joint ventures with options to buy shares at predetermined dates. Those are the ones that I've seen the most, but absolutely, I think they're definitely the case. Also, some of the sellers might need funding to be able to pay the severances or for any reason. So, yes, absolutely. Creative deal structures are definitely happening in Asia.
Thank you so much, Margaret. This is such an important area for so many funders or businesses in general looking for M&A. There are endless ways to do a deal, so long as the intention to do deal is there. So, and those who do not have experience might think that there are only a couple of ways to structure a deal. In actual fact, that could not be further from the truth, because there are so many ways. There could be earnouts, as Margaret was saying. There could be a share buyback in future. There could be so many ways. There could be so many ways. So, and we could actually spend hours and hours talking about these things. So, it's we're just giving you a small flavor on this, But again, there's lots of education here about how to do these deals. And I wanted to ask you also this question about currency risks, because we tend to see volatility in the currency markets in Asia more than we see in Europe or in the USA as well, in more developed markets. Just tell us in your experience, yeah, what is the role the currency risk or foreign exchange exposure play when you have to structure a deal?
I mean, you cannot disregard the foreign exchange risk nor the currency risk because obviously it gives an additional layer of risk. So it is a measure of stability, right? Just as growth, just as interest rates. And so the more risky the deal, then obviously the valuation becomes less interesting. But that doesn't mean it does not happen because there are a lot of mitigation and deal structures available to protect you against the foreign exchange. So then what is very crucial is to have the right negotiation in the right environment for in order to find an agreement basically with the seller. But there are protection mechanisms and they just need to be agreed upon.
No, thank you for telling us this, Marguerite. I think it's fair to say that we are dealing with such a fast-growing world in Asia that the economic changes, they really dictate obviously the changes obviously in so many variables. And one of these variables is currency. It's currency risk. We know that, for example, we go probably one of the fastest growing economy for the next two generations is going to be India. So let's say India rupee is one of the currencies to watch, for example. There are so many factors at play, so many macroeconomic factors at play. Don't forget about geopolitics as well. Obviously, that's something else that so we never should underestimate in terms of what it can do, especially when we look at recent development across the world. Uh,
Absolutely.
so you want to say something, Margaret, on that? Yeah.
No, no, no. I was just agreeing with you.
Okay, so yeah, we go also geopolitics, and in general, the conclusion we can say with the experience of those who've done it so many times, like Margaret, the conclusion is that financial implication in an M&A deal could be so wide, it could be so widespread. In particular, when you're looking at deal structure, um, there are just countless ways to make it happen. If you really want a deal, make it happen. And one of the suggestions I would always make is don't wait to be perfect because perfectionism will destroy a deal. So if you decided that you're going to go for a deal, but you're waiting for the exact perfect economic circumstances, you might actually miss the boat. Yeah. So that's a very important consideration.